Chart patterns. The market repeats certain formations over and over. Knowing what they are can put the odds of a successful trade in our favor. What I'll cover here are some of my favorite chart patterns that will deliver a higher than average probability of a successful trade. These patterns are reliable and many traders watch for these. Because of the number of traders waiting to trade these patterns, they have a kind of self-fulfilling prophecy thing going on. They are more likely to work out simply because the big money trades them too. There are 4 trend following patterns or continuation patterns, and there are 2 counter trend or reversal patterns that we're going to look at. These are the most widely used patterns that traders look for. The trend following patterns are going to be the symmetrical triangle or the pennant, the ascending and descending triangle, the flag, and the rectangle. And the trend reversal patterns are going to be the wedge and the head and shoulders formation. The symmetrical triangle or the pennant. These are essentially the same formation. As the market is pausing, you will find price retracting into a narrower and narrower configuration. The market squeezes itself from both the top and the bottom. The symmetrical triangle and the pennant show up just before the market takes off in its original trend direction. This is a symmetrical triangle or pennant formation on an actual live chart. On the left, we see the bullish pennant as price rises and then gets constricted into a triangle formation and then breaks out in the direction of the original trend upwards. On the right, we see the same thing going down. The market moves downwards first and then it pauses. And as it pauses and moves sideways, it gets restricted tighter and tighter and then finally breaks down into the original trend direction. The ascending and descending triangle. This continuation pattern is similar to the symmetrical triangle, but in the case of the ascending or descending triangle, the leading edge of the triangle is a flat line, a horizontal line of support or resistance. Price will usually break through the horizontal edge in the direction of the previous trend. Again, we're looking at live examples of both an ascending and descending triangle formation on real charts. On the left, we have an ascending triangle. The top edge is flat, and as we are approaching this edge, market has a difficult time breaking through it, but the bottom of the market is getting higher and higher. Finally, price breaks through this flat horizontal level of resistance and continues upwards. On the right, we see a descending triangle. Price moves down and hits a floor. It has a difficult time getting through the floor, while the top of the market is getting lower and lower. Finally, price breaks through the floor and continues in the original trend direction. The flag. A flag pattern is a pause in the market. It starts off generally with a large, quick move, forming a fairly steep pole. Next comes the flag formation itself as it gently moves up and down slightly against the initial move. To be a true flag, the formation takes place between 2 equally separated lines, a small support and resistance channel. Again, we're going to look at some live examples. This on the left is a bullish flag. The market moves up fairly steeply and then it starts to move sideways with a very slight down trend. Once it breaks above, it will continue to move in the original trend direction. On the right, we see a bearish flag. The market moves down very strongly and then kind of consolidates as it moves sideways and slightly upwards. Once the consolidation is over, price will break down through the bottom of the channel and then continue in that original trend direction. A rectangle. As price slows down after a bigger move, it will want to drift sideways for a while. This drifting will have price floating up and down within a range. It can be very narrow, as in a consolidated market, or a little wider where there's actual price movement inside of it. We're looking at a couple of instances of rectangles on a chart. Price moves up on the left. We have a move up and then a consolidated state where the market just bounces up and down for a little while as it moves sideways. This movement up and down is confined between a horizontal level of support and resistance. Price does break through the top and continue on the way of the original trend. On the right, we have a bearish rectangle. Price moves down fairly steeply and then starts to move sideways. As it moves sideways, it is confined within support and resistance level and eventually does break down into the direction of the trend. The wedge. This is a reversal pattern. Price must be trending in one direction to begin with. The leading edge will start to flatten out while the trailing edge will continue to move in the direction of the trend. This will result in a squeezing of the price in the direction of the trend. Price will then change direction and break out in the opposite direction. A couple of examples are as follows. On the left, we see a bullish wedge. Price is dropping. The bottom edge of the wedge starts to get flat. It's almost horizontal. It's not quite. It does make lower lows, but each lower low is very subtle, while the top is still making significant lower highs. Eventually, what's going to happen is price breaks out in the opposite direction. The trend starts down in this case, and then it will break to the upside. On the right-hand side, we see a chart of a bearish wedge. The market is moving up, and then as it hits a high, struggles to make higher highs. It does, but just barely. The bottom side of the formation continues to make higher lows without much effort. Finally, we do get a breakdown, and the market will continue in the opposite direction. The head and shoulders formation. This is also a reversal pattern. In an uptrend, price makes a higher high and then a lower high is formed. A break below support triggers a short trade. In a downtrend, price makes a lower low and then a higher low is formed. The break of resistance is the trigger for a long trade. Here we have a couple chart examples. The head and shoulders pattern on real charts. Number one on the chart on the left. Number one is the left shoulder. Number two is the head. Number three is the right shoulder. This is called the inverted head and shoulders because it's upside down. One, left shoulder. Two is the head. Three is the right shoulder. This is when number three makes a higher low than the head. We have the beginnings of a trend reversal. Price breaks above this level of resistance and the trend changes direction. On the chart on the right-hand side, we have a standard head and shoulders formation. Price makes a higher high from 1 and 2, 1 being the left shoulder, 2 being the head, and then 3 being the right shoulder, fails to make a higher high. This becomes a lower high. This is the beginnings of the change in trend direction. As we draw a level of support, price breaks below this level of support and then continues in the opposite direction. Initially, with the head and shoulders formation, the price is moving up, and then it changes the direction of the trend, and then price breaks down.